Welcome back, students. This is your teacher Roy with a video lecture for chapter number 2, which is quite long, so I've divided up our chapter into two parts. So this is part 1. If you're not my student, you're still welcome to watch this video, but if you need some type of tax advice, you have to seek a professional. If you are my tax students, you're always welcome to contact me even after the semester's over to get my informal opinion about your specific tax situation. Here in Chapter 2, we're getting a big overview of calculating taxes, and we'll go into much more detail in future chapters. So we've seen this basic tax formula before. Now we have a little bit more detail, and we'll take a look at the Form 1040 to get even more detail. So we start off with all the different types of income a taxpayer can have during the year. But then not everything is taxable. We're going to back out the non-taxable, but here we use the term excludable. So we're going to see, I believe, in chapter number 4, specific calculations of things that can be excluded. So when we subtract out exclusions from the total income, what we get is the leftover income that is subject to tax or taxable, or we use the word includable. And this is going to be our chapter number 3, our next chapter. So we're going to be classifying income to different types of categories, and we'll see certain types of income uh, have to go through a calculation to either be more or less taxable or taxed at different rates. We're going to subtract out deductions, not all the deductions, to get to a figure called adjusted gross income. So this type of deductions, we'll see some here in this chapter 2, but more so I believe they're covered in chapter number 5 or 6. And then after subtracting out these deductions for, that's a preposition we'll emphasize in this chapter, for AGI, we get AGI or adjusted gross income. And then we subtract out some more stuff. One of the two different categories here are deductions either called itemized. This is the typical ones we hear a lot, like home mortgage, charitable contribution, maybe medical expenses, union dues, or a standard deduction, a flat dollar amount, depending upon the taxpayer's filing status. And we're going to learn about filing statuses, I believe, at the end of the chapter 2. So notice the preposition or conjunction here, or it's one or the other, not both. And of course, we want to deduct the higher of the two to eventually reduce our taxable income, this number down here. Okay, so we subtract this out, keeping in mind we've already subtracted out other deductions up here. So this group of deductions are called exemptions. Our textbook kind of calls everything exemptions here personal, but we're going to see personal, at least in my lecture, are the ones for the taxpayer or the taxpayer's spouse if we're filing a joint return. The other type of exemption is everybody else being claimed on the return, called dependents. So these are subtracted out, and one of these two is subtracted out from the AGI to get our taxpayer's taxable income. And then we look this amount up on a tax table, or we've seen in chapter 1 something called a tax rate schedule. We would use the tax table if possible. Typically, if this number here, the taxable income, is under 100,000. If it's more than 100,000 or more, we have to use the tax rate schedule. So then we get the gross tax for the whole year, the tax liability for the whole year. Then we're going to minus out taxes we've already paid called prepayments. Typically, this would be the taxes withheld from your paycheck or estimated taxes you paid quarterly to the government directly, or maybe taxes that you had overpaid last year and credited to the current year. We're also going to learn tax credits being subtracted from the gross tax. Um, Most of the credits we'll learn this semester is going to be covered in our last chapter of the semester, but we'll learn one this chapter 2 called the child tax credit. And either now we're going to have an overpayment that we can get refunded back to us. Keep in mind that the money coming back to the taxpayer is not called a tax return. Tax return is the whole big form you're filing, all of the forms and schedules you're filing. The money that you get back from the government is called a refund. And maybe if you want to, you can apply it to next year's prepayments. Or most of us really like to get that windfall and spend it one time, right? I'll just blow it on one big thing. But if you still owe money after these credits and prepayments, then you have a net balance due or tax payable with the return. We learned that in chapter 1, if you pay this late, you may be penalized and probably get charged interest. Okay, so let's get into a little bit more detail in this tax formula by looking at the tax form, the 1040 tax form. I know it's tiny here to read, but this is the example given to us in our textbook for chapter 2 regarding the lanes. Yeah, the lane tax return. So you have their name, social security number, mailing address, and we're going to learn about filing status in this chapter, again at the end of the chapter. We're going to learn about the exemption deductions. The names here would be dependents. The names up here would be taxpayer and spouse. This first section of dollar amounts is income. Again, this is our chapter number 3. Keeping in mind that you're going to be subtracting out deductions within the amounts listed here. For example, if you're, well, we'll get into the detail in another screen. So this first section is income. Then here's a bunch of deductions called adjustments. So when you subtotal these adjustments and subtract it out from the gross income, you get a figure called AGI, or adjusted gross income. So this is the front page of the 1040 form. The terminology is slightly different for taxes compared to financial accounting that you've learned in previous semesters. For example, in financial accounting, you learn the term revenue and you minus out expenses to get something called net income. The comparable terminology for taxes is revenue is income and expenses are deductions. Keeping in mind, not all revenue is taxable. Not all expenses are deductible. So the bottom line after subtracting out the deductions from the income is our taxable income that we saw on that simple formula that we multiply or look up on the tax table to get the tax for the year. So this taxable income would be on the second page of the 1040 form. Here's the AGI amount again, subtracting out standard deduction or itemized deductions and exemptions to get the taxable income, okay, comparable to the net income on a financial statement that we look up on the tax table to get the tax for the whole year. We subtract out credits, we subtract out prepayments to get, in this case here, an overpayment that's going to be refunded to our taxpayers that sign off down here. Okay, so that's the 1040 form. There's other forms and schedules that we'll see throughout the whole semester besides this 1040 form. And you'll get a chance to fill out a few of them as projects for the semester. So here's our first category again, income, yeah? According to the tax law, any income is taxable unless it's specifically excluded, treated as non-taxable by the law. This includes any gains we have on the sale of property, here called a capital asset. So this example here has a gain of $300. So there's a sales price of 1,000 and a cost basis. This word basis is good to know as a tax term. We'll see the term also called adjusted basis. We subtract that from the sales price to get a gain or loss, in this case a gain of $300. Now what is treated as income? It's not this $1,000, yeah, it's this $300 gain that is treated as income. Likewise, if this were a business, you would have sales minusing out the cost of goods sold to get the company's gross profit. For tax purposes, income is this gross profit and not necessarily the sales price of what was sold. So here's a list that we'll go into more in detail when we see chapter number 4 regarding income that is non-taxable. Or here the word is excluded, exclusions. So if someone gives you a gift in a non-business setting, the phrase is for love and affection or admiration, and you receive that gift, you don't have to report it because it's excludable. Now, there is something called a gift tax, but the gift tax, if there is one, is not paid by the person that gave the gift, called the donor, excuse me, the donee, but it's paid by the person that gave the gift, called the donor. And generally, if the gift is under 14,000 for the year for that one specific donee that received the gift from that one donor that gave the gift, there is no um, reporting requirements. There is no gift tax. But if the gift made is over 14,000 by that one donor to that one donee for the year, then the donor has to probably file a gift tax return. And that's out of the scope of our income tax class for this semester. I did see listed on the availability schedule for classes at our Manoa campus. I believe there is a graduate class being taught for estate and gift taxes. Um, I haven't seen it offered here on our West Oahu campus, an estate and gift tax class. If you receive life insurance when someone passes away, generally, if it's again not in a business setting, that life insurance proceeds are excludable, non-taxable. If you receive um, welfare benefits, let's see, what was that main one? The 10F, food stamps, Section 8 housing allowance. There's a couple others like Social Security Disability Insurance. If you receive any of these type of benefits, they are excludable. They're not even reported. Now, if you receive income other than these things, maybe these benefits will start to be decreased, but that's not a direct effect of this being not reportable on your income tax return. Okay, so tax-free welfare benefits. If you receive a scholarship and you use it for qualified education costs, then the scholarship is tax-free. And that means if you receive a scholarship and don't use it for qualified education costs, like room and board is not a qualified education cost, that scholarship is generally taxable, yeah, includable. If you have to pay back, if you get payments because you were injured and this injury was a physical injury, generally those payments are tax-free. If you get payments for medical costs because of someone else's fault, the coverage of that medical cost is tax-free. If you get payments for non-physical damages, like slander, libel, even psychological damage, you got payments for that. Possibly those payments are taxable, includable. We'll have a chapter that covers employee benefits. A lot of them are tax-free, and some of them may be taxable. Just because they're employee benefits doesn't make it tax-free. The main tax-free employee benefit most of us get is probably health insurance paid by our employer. If you have earned income by working outside of the country, earned is another word for work income, yeah? It's not investment income. Possibly up to a little over 100,000 can be excluded that we're going to be learning in chapter 4. Interest income generally is taxable unless the interest is earned from municipal bonds issued by our U.S. states and counties and cities, municipalities. The interest is tax-free for U.S. purposes, yeah, tax exempt. Series E bonds, savings bonds, U.S. savings bonds are generally tax deferred, postponed on the taxation until you cash in the bonds. But if you cash in your bonds and use the bond proceeds, not just the interest, for qualified education costs, then possibly that interest on the savings bond is tax free. Leasehold improvements, you have to take the viewpoint of a landlord where the tenant makes improvements to the property and then leaves those improvements for the landlord when the tenant leaves. That betterment to the property is a tax-free income to the landlord. So you do a good job at work. Generally, any bonus you get, award you get, is taxable, unless there's a formal program to award employees for safety and longevity. The typical thing here would be you see the countdown of how much days they've gone by without any accidents. Typically, that means all these employees are waiting to get an award at the end of the year if there's no accidents. That would be an award like this that could be tax-free. There's a dollar limit. Or the so-called proverbial gold watch you get when you retire could be a tax-free benefit. Payments at a divorce or due to a divorce. So if you split up the property at the end of a divorce, that's a property settlement that's tax-free. If you collect child support, that's a tax-free income. If you collect alimony, that's taxable, not excludable or includable. If you sell your home, if you meet certain conditions, up to 250,000 for single or half a million, double this for married filing joint couple, could claim a gain, not sales price now, but a gain that's tax free. If you take money out from a retirement account here on an IRA, specifically a Roth IRA, taking money out is called a distribution, and if you meet the requirements, that's a tax-free income. COD or cancellation of debt. You don't have to pay back money that you had borrowed. Could be excluded. You know, the general rule is that it's includable, but it could be excluded for certain types of transactions that you had used the borrowed money for, or possibly if you're in bankruptcy or what they call insolvent, then maybe the canceled debt that you didn't pay back, and that's a benefit that you didn't pay back, could be tax-free. Social Security benefits, the general rule is tax-free, but it could be taxable, and we're going to learn in Chapter 3 a formula to calculate the amount that is taxable. Let's take a look at the next list for income that is taxable or includable. And here they reference a specific section of the Internal Revenue Code. So if you Google IRC section, I guess you maybe should spell out SEC section 61, you pretty much will come out with the same list with more detail. And then the United States Treasury, we talked about tax authorities in chapter 1, would also have more detail about these specific categories of income. So the most common type, of course, is wage or salary. That's reported to us on a form W-2 each year after the year's over. If you have your own business, all the fees you charge during the year to your clients, or all the gains, gross profits you have for selling merchandise, that would be included here. First reported on a schedule letter C, and then you would minus out deductions, which is a separate topic here in our chapter. But here we're just looking at the gross business income. And then any net income left over then would be reported with your 1040 form with your W-2 and other income. Gains, remember again, gain is sales price minusing out costs, or I'll use the formal term adjusted basis to get a gain or a loss. Generally, a gain is taxable unless specifically excluded in certain situations. Losses are generally not deductible unless specifically allowed. Business losses are allowed. Investment losses are allowed. Personal losses, like your automobile you sell for less than its cost, is not allowed. But if you sold it for a gain, taxable. We'll have a chapter just on gains and losses, capital gains and losses. Interest income, unless it's that municipal bond interest we talked about in the previous slide, generally is taxable, reported to the taxpayer on Form 1099 I and T. If you're a landlord, the gross rental income is going to be reported by the taxpayer first on a Schedule C, Schedule E. Then you would deduct the rental expenses. Again, here we're just focusing on the gross income, yeah? Gross income. Royalties are similar to rent income. You're lending something to somebody and they're giving you a periodic payment. Dividend income, just like interest income, reported on a 1099 DIV to the taxpayer. And we're going to see a special calculation in Chapter 3 regarding something called qualified dividends. If you receive alimony, not property settlement, not child support, but alimony specifically mentioned in the divorce decree, the legal papers for a divorce approved by the court, that is going to be income to whoever receives it and a deduction to whoever pays it. Annuities are related to insurance. Instead of taking the proceeds all one time, you kind of spread it off for so many years over your life, and any extra over the initial life insurance benefit is treated either as interest or this annuity income. We saw life insurance as an excludable item on the previous slide, but if it's somewhat related to a business event, a business transaction, it could be a taxable amount, a taxable income. Pension income, by definition, is a benefit paid by the employer. Yeah, and we'll talk more about pension income being taxable in future chapters. Again, here's the cancellation of debt. Could possibly be excluded, but the general rule is that it's includable or taxable. Partnerships do not pay income taxes, but they allocate their income and deductions to the partners, the so-called flow-through entity. And if you have a partnership income to report, the partnership will give the partner a Schedule K1, then that's retotaled on a Schedule E before then regrouped on the 1040 form. Here's a uncommon type of income called income in respect of a decedent. In my career, I think I've seen this only a couple times, where basically you have to report income on an accrual basis for estate tax purposes. Remember, when a person passes away, anything of value has to be reported. Well, this accrued income has value, and it's reported here on the estate, and estate taxes are paid on it. But because the taxpayer who passed away had reported income taxes on a cash basis, this uncollected income was not reported for income tax purposes, but only estate tax purposes. So whoever is the beneficiary of the estate that does collect this income has to report it as taxable income. And there's some other related calculations in terms of the estate tax paid on this that the beneficiary can claim. An estate or trust also pays possibly income taxes if it doesn't distribute the income to the beneficiaries. But if it does distribute the income to the beneficiaries, a K1 is going to be prepared, and then that taxpayer beneficiary has to report it on their Schedule E, again summarizing it before it's then put on the 1040 form. Here's that income section, a little bit close-up view. So we've talked about wages reported to the taxpayer on a W-2 form. We talked about interest income. If the total for the whole year is $1,500 or more, you have to first itemize the specific banks, financial institutions where the money came from on a Schedule B, and then take a subtotal and put the subtotal here on the 1040 form. We've mentioned that tax exempt interest from those muni bonds are not taxable, so it's not included in this line 8A. In our case, in this example, the 4,000, but it's broken out off to the left side and not totaled in this column that's eventually going to be taxed. You still have to disclose it on your tax return, the tax exempt interest. And for the past few years, whoever's paying this interest typically issues out a 1099 INT form, classifying it as tax exempt. And again, broken out separately from the taxable. Here's your dividend income reported in lines 9A and B. Again, first reported to the taxpayer on a form 1099 DIV. And just like interest income, if it's totaling up to be $1,500 or more, it has to be then reported first on Schedule B. Schedule B probably would have just the ordinary dividends with the subtotal here. And within this ordinary dividends, there may be qualified dividends. So there's a number here that's already included in this number here that's being taxed with the total income. Compared to this municipal interest, it's not inside of this number here, not being taxed in the total income. Eventually, we're going to learn in Chapter 3 that we're going to back out this qualified dividends from the taxable income and tax those qualified dividends at a lower percent, a lower marginal rate. Line 10, if you deducted state or local taxes in the previous year as an itemized deduction and got the money back as a state tax refund, that refund has to be reported as income because you got a benefit of those taxes as deduction in the previous year. Now, if you did not claim, did not itemize the state income tax deduction in the previous year and still get back a state refund, that refund is not taxable because you did not get a benefit of paying those taxes initially in the previous year. In the case of a federal income tax refund, it's never claimed as income here when you get back that money because it never is reported as a deduction. It is reported as a prepayment, but you don't claim it as a deduction in the previous year. So when you get back the federal state tax refund, it's never taxable as income. Here's the alimony you got, taxable. Business income, you first have to report it on Schedule C and minus out the business expenses, leaving the net income to be rewritten here on line 12 of the 1040. We'll have a couple different chapters regarding gains and losses. The main form for a gain is a Schedule D. and other sub-schedules showing more detail. But ultimately, we combine all of those together and put down one figure here for the net capital gain or loss. We'll see there's other types of gain or losses too here. Here's retirement income. Retirement income. Yeah, Social Security is retirement income. You have to show the gross amount you collected for the year, and of that, how much of it is taxable combined with the other taxable amounts. So that's going to be calculated in the next chapter or future chapter. Here's your landlord income. First reported on a Schedule E, minusing out the rental expenses from the gross rental income. If you're a partner in a partnership, if you're a shareholder in an S corporation, if you're a beneficiary of an estate or trust, you may be receiving that Schedule K1 I mentioned, and whatever income is reported on here now has to be reported on your 1040 form, possibly first on this Schedule E, possibly on other schedules, then subtotaled here on the 1040 form. If you receive unemployment compensation, taxable, you're going to get a form, let me write it down here, 1099G from the government. Same thing with the state refunds. You may receive a 1099G. Social Security benefits reported to the taxpayer on a form SSA 1099. Again, the gross amount here, we have to go through a worksheet calculation to find out how much of it is taxable. If your income is not one of these specifically itemized items, then there's a catch-all, other income here in line 21, where you write out a description and then the dollar amount. The common ones you see here for Hawaii taxpayers is their winnings when they go to Vegas, or jury duty fees, or some type of stipend that wasn't reported as income up here as a wage or salary. Okay, and then here is the total for the income section. Here's the total for the income we just saw, yeah? Now we're going to subtract out deductions. Keeping in mind, business deductions were already subtracted out in those Schedule C or E to get to this figure up here. Now deductions subtracted out next are called deductions for AGI, to get to AGI. So we'll go through some of these here. We already seen the business ones, yeah, already subtracted out from the income. And then we're going to get AGI. Then we're going to subtract out some more deductions called from AGI deductions. So here is the line, AGI. And if you get to subtract out expenses above here, those are called above the line deductions. Or expenses below are called below the line, or for deductions, or from deductions, those two prepositions. Here are for. We've already talked about trade or business deductions being reported on that Schedule C for business owners, self-employed proprietors, or Schedule E for landlords, or already subtracted for partnerships on a partnership return, and the Schedule K1 is now being re-reported here on Schedule E. This is a little bit tricky one here. If you are an employee versus an employee versus a business owner here, and you pay expenses for your job, and you get reimbursed for those expenses, basically it's reporting the reimbursement as income, and then subtracting out the out-of-pocket expenses, leaving nothing left, right? It cancels off. If you pay this out-of-pocket expenses and your employer requires you to provide them receipts and records for those expenses, and here they reimburse you, technically there is nothing to report on your tax return. But if you pay these expenses and are not reimbursed, these expenses are going to be claimed as an itemized deduction on Schedule A. To be able to offset any reimbursement, the employer has to require you to turn in receipts, to turn in records for these expenses. If the employer just gives you an allowance and doesn't require you to turn in any expense report receipts, that technically allowance is more wage income, more salary income. Okay? But if the employer requires you to turn in receipts and expenses and get this reimbursement, it offsets what you pay and there's nothing to report. If you get more reimbursement than expenses, the excess reimbursement is taxable. If you get more expenses than reimbursements, the excess expenses, itemized deduction. There are certain situations where um, excess expenses can be for, but most times it's from. Here's the opposite of the gain on the sale of property. Keeping in mind not all losses are deductible, including personal capital losses, capital asset losses. Typically, the most common example is you sell your car, your personal car, at a loss, non-deductible. Rent expenses we've seen before, claim on Schedule E. This one I'm not too clear about. Probably if we're talking about being a beneficiary of a trust and getting a K1, and that trust has subtracted out um, rental or business expenses on their return. Retirement plan contributions. Certain contributions the taxpayer puts into retirement accounts are deductible. The common ones is a traditional IRA, or if you are self-employed, your own business, you can put something into a retirement account called a KEO plan. When you put this money in, that's called contribution, you can take a deduction. Contribution and deductions are two different terms, not the same thing. We saw that interest being earned from a bank, that's taxable interest. But if they charge you for a penalty for taking money out early, typically from a certificate of deposit where you're supposed to leave it for a certain time period, you still get your interest income, but then they charge you a penalty. That penalty, one of the few so-called penalties that are deductible, it can be deducted as a 4 AGI deduction on the 1040 form. If you have your own business, again, a Schedule C or a partner in a partnership, possibly that income is not just subject to income tax, federal and state, but also subject to Social Security taxes. And since they don't withhold the FICA taxes, Social Security tax, there's going to be a Social Security tax called self-employment tax assessed on the business profits, and it can range between 14 and 15%. Such a big hit that the government gives a break to these self-employed taxpayers by allowing them to take a deduction for half of that, not income tax, but Social Security self-employment tax. Self-employed individuals cannot get a tax-free benefit, health insurance benefit from their own company because they're not treated as employees. So when they pay their self-employment health insurance premium, they can claim it as a deduction for AGI, not a business expense, but a for AGI deduction. Here's alimony being paid. Again, not child support, not property settlement can be deducted. Moving expenses. Again, we'll learn all more detail on all of this. This is reported on Form 3903. Repayment of unemployment compensation. When you receive unemployment compensation taxable, if for some reason you have to pay it back, you can deduct it as a 4 AGI expense. Jury duty pay taxable. If you have to pay it back to your employer because it's still going to pay you your regular salary or wage, you get to deduct that payment of the jury duty paid back to your employer. I'm not too clear about this one. I think it may be business related. Here's something that some of you may be eventually paying, hopefully not too much. When you start paying back on your student loans, it's not an itemized deduction like home mortgage interest, but a for AGI deduction. And we're going to see some income limitations on this in a future chapter. This one here probably should be classified now as a health savings account. And if you contribute into this type of account, you can take a deduction. So we did talk already about income. Now here's those adjustments, yeah? So the ones we've mentioned, some of them are here already. I don't think we talked about educator. This is for K to 12 incurring classroom expenses out of pocket that's not reimbursed, yeah? Moving, let's see, people that have their own job, their their retirement account. Again, this is the KEO plan. This is the health insurance for the self-employed. And somewhere here is that half the self-employment tax. Here's alimony, and the government wants to make sure if you're receiving the alimony up here, you're reporting it as income. So whoever is paying it here, they got to report the social security number of the ex-spouses that are receiving the alimony, so they can cross-reference it to the other tax return. Student loan interest, that's calculated on a worksheet in the instructions to the 1040 form. Tuition and fee deduction, probably you want to claim this as more of a tax credit and not a deduction here on the 1040 form. Okay, so you take a subtotal, subtract it from your gross income to get the AGI. That's recopied to the top of the next page. Then we subtract out itemized or standard deduction and exemptions to get the taxable income and figure out the tax. So page 2 of the 1040, subtracting deductions from AGI. Again, it can either be the itemized ones, then you have to fill out a Schedule A, or standard deduction, a flat dollar amount depending upon something called filing status, maybe age or blindness. And then exemptions, be there for the taxpayer or spouse called personal, or everybody else being claimed on the return called dependent exemptions. For each exemption you're claiming, you get to deduct $4,050. That's been the same amount for the past couple years. So here's the categories of itemized deductions. We'll take a look at a Schedule A to see a little bit more detail. And here's the regular standard deductions based upon, let's see, it's supposed to be 5 filing statuses. Single, head of household, married has 2 different ones, separate and joint. What's not listed here is surviving spouse, or sometimes they call it qualified widow or widower, which is very similar to the married filing, joint filing status, at least the dollar amount of the standard deduction. And if you're an older taxpayer, older meaning 65 and older, you get an additional standard deduction in addition to these amounts here. Same thing if you're legally blind. That's for both the taxpayer and spouse. We'll see if there's amounts listed here. So here's the dollar amounts for 2017 tax returns. If you're taking a look at the 2016 1040 form, off to the side in the margin will be a short list of different filing statuses and the related standard deduction. You can see that the single and the married filing separate, just one of the spouses can claim the same amount of standard deduction. And here the joint is just double the standard, yeah, of single or separate. And the head of household kind of falls in between the single and the married filing joint. And again, that qualifying widow or widower or surviving spouse would be claiming this amount of standard deduction. And we'll talk about these filing statuses again at the end of probably the next video lecture. If you are age 65 or older, let's see, I believe it's married and blind or blind, you get an additional amount of standard deduction. If you're unmarried, I believe the additional amount is a little bit larger than this. So here's itemized deductions first reported on a Schedule A. So here's the different categories: medical, taxes. Notice you cannot claim here the federal taxes you've paid, interest, charity, casualty losses, and miscellaneous. In the case of medical, just one lump sum figure for all the out-of-pocket costs that was unreimbursed, not covered by insurance. Basically, this is your co-payments and your deductibles. But you can't deduct the whole thing. They're going to tell you to put your AGI over here and take 10% of it and subtract it out. And only the remainder, if anything, can be added with your other itemized deductions. Keeping in mind that this bottom amount, you try to get it bigger than your standard deduction. Otherwise, you're wasting your time trying to fill out this Schedule A. Taxes, the main one most of us pay is Hawaii income tax. Some states don't have an income tax, so they may claim the sales tax. We can claim our general excise tax here also, but it's either or, yeah, not both. And if you own real estate tax. I mentioned in Chapter 1, Hawaii does not have a personal property tax, so nothing should be here for us. Other taxes, some states have a state disability insurance. We don't. California has. Foreign income taxes, you probably don't want to claim it here, but claim it as a credit. Again, we'll report credits in our last chapter of the semester. Possibly the big deduction that triggers you to switch from standard to itemized is when you borrow money for a home loan, a mortgage. And that's going to be reported to the taxpayer on a Form 1098. And you're also going to probably pay real estate taxes if you own a home, right? Besides your mortgage. There's a couple other mortgage costs here in this section. Charity, cash, and non-cash will determine possibly different levels of you can claim. It's not in the calculation here, but typically you may be limited, and we'll learn this in the itemized chapter, 50% AGI or 30% AGI, depending upon what you donate and possibly who you donate to will determine these percentages that you report here. No more than 50 or 30% of your AGI. If you have a casualty loss, like a condominium fire or tsunami or hurricane damage, or even a car accident, and then a lot of it is not covered by insurance, we go through a calculation on a tax form here and only put the amount of the loss here. We'll learn this form in a future chapter. Miscellaneous expenses, kind of here there's two groups, one related to being an employee for unreimbursed, and here are investment expenses. This middle one here, maybe you should not incur anymore after taking this class. You're paying a tax preparer to do your return. Maybe the only fee you should have here is the fee they charge you for software for doing your own return. You take a subtotal here. Here's the AGI amount, and they take 2% of that AGI and reduce your miscellaneous to get what's deductible. So even though you pay a lot of union dues, a lot of working dues, uniform, possibly you end up with zero because of this reduction of 2% of AGI. This other miscellaneous, the most common one we see here is maybe gambling losses, but only to the extent gambling winnings are being reported. The gross winnings being reported back on the 1040 form. You can report gambling losses here to that extent. Not too common to use this bottom line down here. So we take a total, and we compare that to the standard deduction, and we take the larger of the two and report it back on the 1040 form. Let's see. I've never seen an individual report a tax return less than 12 months. So this is not a common situation here. Non-resident aliens would prepare a form called 1040 NR, and they cannot claim a standard deduction. Yeah, they have to itemize if anything. So let's say we have a couple here. We'll call it taxpayer and spouse. So they can file a joint return, married filing joint, or each can file separate returns, married filing separate, married filing separate. If it's a joint return, we can deduct expenses, including the itemized deduction or standard deduction. They get to choose, yeah, one or the other. Now, if they file separate returns, they also can choose. If you claim standard, the other spouse has to claim standard. If you claim itemize, the other spouse doesn't have a choice. They gotta itemize too. It cannot be different, yeah, from your spouse. So I've seen situations where the spouses are not in contact with each other. So we try to file a standard deduction, and the IRS disallows it because they say you don't know, because you're not in contact, you don't know whether the other spouse had itemized or not. To me, it's more common to claim the standard, but the IRS said no, you gotta itemize because you don't know whether the other spouse had taken the standard or itemized. So gotta be the same, yeah, standard, or itemize on separate returns. Exemptions, the other deduction before arriving at taxable income, again, it's $1,050 per person. You can claim one for yourself and one for your spouse. So the maximum personal are two. If you're doing a Hawaii tax return, if you have age 65 or older, they don't give you extra standard. They give you an extra personal exemption. That's Hawaii rules, yeah, not federal. And for each dependent you claim, here they call them personal, but it's really a dependent exemption. If a taxpayer being claimed as a dependent of another, he or she cannot claim him or herself. In other words, if you're claimed as a dependent and you file your own tax return because you have income or trying to claim a refund, you cannot claim your own personal exemption because you're being claimed as a dependent. And of course, it makes sense. A dependent cannot claim another dependent. In other words, on a dependent's tax return, you don't see any of these $4,050 exemption deductions. If you are a dependent, you have to meet these rules here. You have to have a Social Security number. You have to be a citizen of the U.S. or a resident of the U.S. or even Canada and Mexico. Okay, they call that citizen test, but it really is either citizen of U.S. or resident of U.S., um, Mexico, and Canada. Resident. Here it says you have to meet a separate return test. We're talking about the dependent here. The dependent, if married, has to file a separate return from their spouse. There's exceptions to that, yeah, but generally the dependent has to file a separate return if they're married for you, the taxpayer, to claim that dependent as a dependent. And here, that dependent cannot be claimed or will not be claimed as a dependent on another person's tax return. In other words, that dependent can be claimed on only one return. One person can be only claimed, exemption can be claimed in any 1 year on only one return. Many years ago, dependents could claim themselves on their own return, and they could probably be claimed as a dependent on their parents' return, but not anymore. There's two types of dependent exemptions. Here they say one type. Is the dependent a qualifying child? And if yes, I guess you go this way. And if no, you go this way. Yeah. So it's not a or over here. If you're if you're a yes, you're meeting these tests here. In other words, you have some type of relation, which we'll see on the next page. You have to pass an age test. You have to live with the taxpayer for more than half the year. The support test is a little bit misleading, yeah, but we'll see what the wording is. And if you're not a qualifying child, you don't meet this test, and you test people for uh, what they call qualifying relative. This is qualifying child, yeah, qualifying child, these tests. And then if not, then you test for qualifying relative. You have to be related or live with the taxpayer for the whole year if you're not related. You have to pass the income test. There's no income test up here for qualifying child. And then there's a support test, which is different from the support test over here. Okay, so let's get into the details here. So for the first one, where we're looking at a qualifying child, no, sorry, this is the test everyone for dependent has to meet, both qualifying child and relative. Yeah, you have to have social security number or taxpayer ID number. You have to be a citizen of the U.S. or you have to be a resident of the US, Canada, or Mexico. So let's say the child you're trying to claim as dependent is a resident, not US citizen, resident of the Philippines. Right there, you're disqualifying that child. Yeah, not resident of California, Canada, US, or Mexico, or you not US citizen. Yeah. And then the dependent you're trying to claim generally cannot file, if married, cannot file a joint return. If the only reason why they're filing a joint return, your dependent and the spouse, is just to get back any tax, there's no tax liability, and they're just getting back the taxes that were withheld as a refund. This is a little bit tricky. That's unclear. You got to look at the worksheet in the instruction book. Okay, so if the child is a qualifying child, one of the qualifying child tests is to be related. Related means natural son or daughter, or adopted, or foster, or step children. Yeah, children from another marriage that now you've married the parent. Or brother or sister, or half brother sister, or step brother or sister, or grandkids, or niece or nephews, right? Sons or daughters of your siblings. Adoption has to be legal. So it cannot be the informal Hanai type we see in Hawaii. Yeah? Again, qualifying child tests, you have to have an age requirement. Has to be under 19. Or if 19 or older, has to be under age 24, where the dependent is a full-time student. Full-time meaning taking at least one semester, that's 5 months, of full-time course load for that semester. So typically, if you're a college student, you're talking about spring or fall semester, and then in our system, 12 plus credits would be full-time. It doesn't have to be for the whole year. It doesn't have to be 6 months, just one semester. Or once you reach age 24, you can pass the age test if the child, if that person is permanently disabled. Another test for qualifying child is that they have to live with you for more than half the year. Temporary absences are still considered to be living at home, like away to school, on vacation, possibly in the hospital, maybe even possibly in the military. Support tests, now let's read this carefully. Dependent, not taxpayer, cannot provide more than half of his or her own support. In other words, that son or daughter of yours pay, that's what support is, paying out more than half of their own support costs. Support, and we'll see this includes possibly the big one, is housing, food, shelter. It's the test here is not whether the taxpayer supports the child. It's whether the child supports him or herself for half of the support costs. Keeping in mind that let's have a taxpayer here or a dependent, yeah? Dependent. Money coming in is income. Money going out, being spent for support costs is support. So in theory, our dependent can be earning lots of income, but if they're not paying support costs for more than half of their own support, then this support test is met because this dependent is not paying out more than half of their support costs, even though lots of income can be coming in. Maybe they're saving it. Another test, okay, so that's the test for qualifying child. So now here's the test for qualifying relative that we use if the person is not a qualifying child. There is a relationship test. Same thing like we saw before. If it's a child, but now we also go back and take a look for uh, ancestors, parents, grandparents, brothers and sisters. That includes now auntie and uncles. Okay, steps, in-laws also count. Here it says cousins do not count. You know your auntie and uncle? They're over here, okay? But their children, your cousins, don't meet the relationship test. Your brother, your sister are over here under child. Yeah? Your grandchild over here. Now your parent and grandparent, auntie and uncle. The says here resides with the taxpayer's home the entire year. This one is for people that don't meet this relationship test. So if your cousin, if your boyfriend or girlfriend lives with you for the entire year, they've met this relationship test. If your boyfriend's son lives with you the whole year, they've met this relationship test. In other words, no blood relationship here, yeah? Dependent needs to only be related to one spouse. Yeah, not both, if it's a joint return. And if someone passes away, the taxpayer or spouse or gets divorced, it's still considered to be related. Now we have a gross income test for qualifying relative, not qualifying child now. The amount they cannot make is over the amount of the exemption for the year. So this is one of the harder tests to meet to get a person to be a qualifying relative. Very easy to make more than this amount for the year. And if they do, right there, it disqualifies them from being a qualified relative. Keeping in mind, qualifying child, that previous test, there is no income test. You could make lots of money. Here's the support test for qualifying relative. That's different from the support test for qualifying child. Now we're looking at the more logical thing, whether the taxpayer supports the dependent, pays for more than half of the dependent's costs. And again, the key one here, the main one typically is the housing. And it doesn't just have to be mortgage or rent being paid, but some make-believe here, they call it imputed amount of value of that housing. It's possible for more than one taxpayer to claim that one person as a dependent. So there's, if they cannot agree among themselves who will claim that person, there's tiebreaker rules to determine who can claim, yeah? So let's see, taxpayer who claimed, whoever can claim that the person as a qualifying child will win over the person that can claim the person as a qualifying relative. Yeah. If one of the two people or more people is a parent that can claim um, the so-called child, then the parent will win versus the non-parent. If it's two parents trying to claim the child, unmarried, separated parents of the child, typically the parent that has custodial uh, has custody for more than half the year is going to win. It is possible that the custodial parent can elect to give the non-custodial parent the right to claim the child, but that has to be affirmatively given, not just automatically taken. Here it says that if none of this 1 and 2 apply, then the taxpayer trying to claim the exemption with the highest AGI is going to win. And again, this assumes that the two or more people that can claim the child cannot agree among themselves who's going to claim the child or claim the relative. Then you use the tiebreaker rules. If more than if no one taxpayer pays more than half of the support, this is the qualifying relative, yeah, it doesn't apply to qualifying child, then the taxpayers who do provide support can agree among themselves in writing with this form who will claim the exemption. I believe whoever claims has to pay at least 10%. Here's the form to give up that right to other people to claim the exemption. For whenever no one person claims can pay more than 50% of the support. And if again a custodial parent has the right to claim a dependent, a child, and they want to give that to the non-custodial parent, this form has to be provided to the non-custodial parent. Let me stop here and I'll continue doing part 2 in another video.